Hey everyone, and welcome back to Talk Tickers. You know how we were talking about AGNC Investment Corporation's latest earnings?
Yeah.
Well, we did a deep dive into their Q3 2024 reports
Oh.
and that earnings call, and let me tell you, there's a lot to unpack.
I bet. It's
Yeah.
really fascinating to see how AGNC is maneuvering within this current market,
It is.
especially given their focus on mortgage-backed securities.
And with the Fed's recent rate cut, things are getting even more interesting.
For sure.
So for those of you who haven't been following along, AGNC is a real estate investment trust that specializes in mortgage-backed securities,
Okay.
mainly those guaranteed by government agencies.
Gotcha.
And their latest earnings report,
Okay.
well, they're boasting a 9.3% economic return this quarter.
That's a
Pretty remarkable.
pretty remarkable figure, especially when you consider that the Fed's rate cut is causing ripples throughout the entire fixed income market.
Exactly.
Yet AGNC is not only weathering the storm,
Right.
but thriving in it.
Okay, so let's break down what's contributing to this success.
Okay.
Their portfolio now sits at a hefty $72.1 billion.
Wow.
And a huge chunk of that is agency MBS.
Oh.
It seems like they're doubling down on this strategy, even with all the talk about the Fed's moves.
Yeah.
What's the thinking there?
Well, they're clearly betting on the long-term stability and potential of agency MBS.
Okay.
It's about carefully assessing risk and reward.
Mm-hmm.
Their average coupon on those holdings is hovering above 5%, which suggests they're targeting securities with attractive yields.
They're locking in those yields while they can.
Exactly.
Okay.
But it's not just about buying and holding.
Right.
Their hedging strategy has also seen some intriguing adjustments.
Okay.
Remember, they've been shifting away from swap-based hedges and leaning more towards Treasury-based hedges, particularly those with longer maturities.
That sounds like a pretty big departure from their usual approach.
Yeah, it is.
What's behind that? Are
Well,
they getting more risk averse?
it's not necessarily about being more risk-averse, but rather about strategically adapting to the evolving market landscape.
Okay.
They're anticipating increased volatility, possibly due to the upcoming election and concerns about the national debt. These longer-term Treasury hedges could act as a buffer against potential market swings.
So it's like they're battening down the hatches, but still keeping an eye out for opportunities.
Precisely.
Okay.
And the shift in their hedging approach is also reflected in their hedge ratio, which has dipped to 72%. This indicates they're not playing it completely safe,
Right.
but they're definitely being more cautious.
All right, so they're loading up on agency MBS,
Yep.
shifting their hedging strategy. What's the overall message they're sending with these moves? What are they anticipating?
They seem pretty confident that the Fed's rate cut is a sign of things to come.
Okay.
They're predicting a return to neutral interest rates within the next couple of years, which could significantly impact the demand for fixed income assets like agency MBS.
So they're positioning themselves to ride that wave of potential demand.
Exactly. They're betting that increased demand will drive agency MBS prices up, boosting their returns in the process.
Okay.
But of course, there's always another side to the coin.
Let me guess. Prepayment risk.
You got it.
Yeah.
It's the elephant in the room.
Right.
With mortgage rates fluctuating, borrowers are starting to consider refinancing.
Yeah.
And AGNC's projected lifetime CPR actually went up this quarter, suggesting they're anticipating a potential surge in prepayments.
That makes sense.
Yeah,
But are they doing anything to specifically mitigate that risk?
that's a great question.
Because prepayments can really eat into those returns, right?
Absolutely.
Yeah.
They're keenly observing refinancing trends and seem to believe that borrowers might not be as quick to refinance as they were during the COVID era. But it's a delicate balance, and they'll need to adapt their strategies accordingly. This is definitely something to keep an eye on.
For sure.
Yeah, definitely. Yeah. It's interesting to consider their portfolio composition within this framework.
Okay.
A significant portion, about 96%, is invested in 30-year fixed-rate securities.
That sounds like they're putting a lot of eggs in one basket.
Yeah.
What's the rationale behind such a concentrated approach?
Well, AGNC believes that 30-year MBS offers the best risk-adjusted return potential over the long term, especially given their expectations for the Fed's future policy.
Okay.
It's a calculated bet on sustained low interest rates.
So they're essentially doubling down on their rate predictions.
Yes, but it's not just about interest rates.
Okay.
They're also considering the inherent stability of the agency MBS market. With spreads holding relatively steady, they see an opportunity to lock in favorable yields.
Right. That makes sense.
Yeah.
What's the average coupon on those 30-year MBS holdings, just to get a sense of the kind of yield they're locking in?
As of September 30th, it was 4.92%. This suggests they've acquired a diverse mix of securities with varying coupon rates, which helps mitigate interest rate risk.
Diversification is always a good thing.
Yes.
Now, what about their TBA position?
Okay.
Those forward contracts for future delivery of agency MBS?
Yeah.
How are they playing that?
Their net TBA position actually decreased during the quarter.
Oh, wow.
It seems they're strategically reducing exposure to this market, possibly due to the less attractive implied funding levels available through conventional TBA roles.
So they're shifting focus from future contracts to holding the securities themselves.
Exactly.
Interesting.
It might signal their growing confidence in current market conditions.
Okay.
Choosing to secure yields now rather than speculating on future market movements.
Speaking of different types of securities, what's happening with the credit risk transfer or CRT securities in their portfolio?
Sure.
Those can be a bit more complex, right?
Yes. CRT securities expose investors to a portion of the credit risk associated with mortgage pools. It's a potential avenue for higher returns, but it also introduces added complexity.
How much of AGNC's portfolio is allocated to these CRT securities?
As of September 30th, their CRT and non-agency securities combined with other mortgage credit investments totaled around $1 billion.
Okay, that's a sizable chunk of their holdings.
Yeah.
What's their strategy there?
They're being very selective with their CRT exposure.
Okay.
They're focusing on specific issuance years and sectors where they perceive attractive risk-reward dynamics. It's more of a targeted approach rather than a broad bet on the entire CRT market.
That seems to be a recurring theme.
Yeah.
Targeted strategic moves.
Exactly.
And that brings us back to their hedging strategy. You mentioned earlier that they're moving away from swap-based hedges, which has sparked a lot of discussion.
Indeed, their increasing preference for Treasury-based hedges is a notable shift.
Yeah.
It suggests a significant change in their thinking about managing risk.
So why the sudden shift towards Treasury-based hedges? What are the advantages for them?
It's a multifaceted decision.
Okay.
One factor is concern about potential volatility in the swap market, especially with the election approaching. Treasuries are generally seen as a safer haven during times of market turbulence.
A safe haven. Got it.
Yeah.
But is that the only reason? It seems like there must be more to it.
You're right.
Yeah.
They're also making a calculated bet on the direction of interest rates and the shape of the yield curve.
Okay.
They're anticipating that longer-term Treasury yields will rise relative to shorter-term yields, resulting in a steeper yield curve.
So they're positioning themselves to benefit from that potential steepening.
Exactly.
Okay.
By increasing their exposure to longer-term Treasury hedges, they aim to offset potential losses on their MBS holdings if rates rise as predicted.
Smart move, but they're not completely abandoning swaps, are they?
Right.
It's all about finding the right balance.
You're right. They haven't abandoned swaps entirely.
Yeah.
They're adjusting their hedging mix to align with their current market outlook. It's a dynamic process of finding that sweet spot between risk and reward.
Now, how does all this affect their financing costs?
Sure.
With all these moves, are they still managing to keep those costs in check?
That's an important point.
Yeah.
Their average cost of funds, including repurchase agreements, TBA funding, and interest rate swaps, was 2.52% in the third quarter.
Cool.
While this is up from 2% in the previous quarter, it remains historically low.
So while their financing costs are creeping up,
Yeah.
they're still in a favorable position.
Yes. Particularly in the context of declining interest rates and the Fed's more accommodative stance. As rates continue to decline, their financing costs should also trend downwards.
That's good news.
Yes.
Lower financing costs generally translate to higher profits.
Right.
But let's delve deeper into that prepayment risk again.
Okay.
We touched on it earlier, but it's worth a closer look.
Absolutely. Prepayment risk is a constant consideration in the MBS market.
Yeah.
And it becomes even more prominent when interest rates decline as they are currently.
I'm still a bit fuzzy on why falling rates amplify prepayment risk.
Sure.
Can you break that down for me?
Sure. When interest rates fall, homeowners have an incentive to refinance their mortgages at lower rates.
Right.
This refinancing essentially prepays their existing mortgages, returning principal to investors sooner than anticipated.
So for AGNC, this means potentially receiving their capital back earlier than expected.
Precisely.
Okay.
And while that may sound positive,
Right.
it can pose a challenge for MBS investors.
Okay.
They often have to reinvest that returned principal at lower rates,
Uh-huh.
potentially impacting their overall returns.
So prepayment risk is a double-edged sword.
It is.
It's a balancing act for AGNC.
Yeah.
What specific steps are they taking to mitigate this risk?
They're closely monitoring interest rates, refinancing activity,
Okay.
and adjusting their portfolio and hedging strategies to adapt to the evolving market.
Okay.
They're essentially trying to stay ahead of the prepayment wave.
It sounds like a constant game of adjustment.
It is.
Now let's shift gears and discuss their performance this quarter.
Right.
They reported a 9.3% economic return, which is quite impressive.
Yeah.
What were the primary drivers of this strong performance?
A few factors contributed to their success.
Okay.
First, the decline in interest rates positively impacted their MBS holdings, as lower rates generally push MBS prices higher.
Right.
Second, their hedging strategy effectively offset some negative impacts from rate increases earlier in the quarter.
So their hedges were doing their job providing a cushion.
Exactly.
Okay.
And lastly, their strategic investments in CRT securities played a role in their overall gains. They seem to have made timely and astute decisions that are reflected in their results.
Their consistent 12 cents per share monthly dividend is something investors are watching.
Right.
Given current market conditions, is that dividend sustainable in the long run?
It's the million-dollar question.
Right.
Based on their current earnings and their positive outlook for the MBS market, the dividend seems well supported for now. However, the market's dynamic nature means AGNC's ability to maintain the dividend hinges on their adaptability to future changes.
So it's a wait-and-see situation.
In a sense, yes.
Okay.
But AGNC has a strong track record of effective management and delivering value to their shareholders. I'm confident they'll continue striving for success.
That's reassuring to hear.
Yeah.
Now let's zoom out and consider the broader economic landscape.
Okay.
How do you see the current environment impacting AGNC's future prospects?
The Fed's rate cut is a significant development,
Right.
signaling a more accommodative monetary policy. This could benefit AGNC in several ways.
Can you elaborate on those potential benefits?
Lower rates typically lead to higher MBS prices,
Okay.
potentially boosting AGNC's portfolio value.
Right.
Additionally, lower rates can make refinancing less appealing for homeowners,
Okay.
potentially mitigating prepayment risk for AGNC.
So it could be a win-win situation for them.
Potentially, yes.
Okay.
But it's not quite that simple.
Right.
There are headwinds to consider, like ongoing trade tensions and the upcoming election. These factors create market volatility and impact AGNC's ability to generate consistent returns.
So even with the Fed's positive moves, a degree of caution is warranted.
Absolutely.
Okay.
The market is always forward-looking and prices in these potential risks.
Right.
AGNC's success depends on their ability to navigate these uncertainties effectively.
You mentioned earlier that AGNC is well positioned to capitalize on the current market.
Yes.
What specific factors support this view?
First, their management team possesses a deep understanding of the MBS market.
Okay.
Having navigated multiple economic cycles, their experience is a significant asset.
Experience is invaluable.
It is.
What else works in their favor?
They have a solid balance sheet with ample liquidity.
Okay.
This provides the flexibility to make strategic investments and withstand potential market storms.
Right.
They also have a diversified portfolio spreading their risk. Their hedging strategy further mitigates negative impacts from interest rate volatility.
Okay.
All these factors combined position them well for success.
A very comprehensive assessment.
Thank you.
There's been a lot of talk about potential risks in the housing market.
Yeah.
Some even suggest we're heading towards another bubble.
Right.
Do you share these concerns?
It's a complex question.
Okay.
The housing market has rebounded from the previous downturn, and prices have been steadily rising in many areas.
Right.
However, the underlying fundamentals of the market are different this time.
How so? What makes this market different from the previous one?
Lending standards are stricter,
Okay.
and there's less speculation driving the market.
Okay.
The supply of new homes remains relatively limited, further supporting prices.
So you don't see the same red flags that preceded the last housing crash?
Not necessarily,
No.
but it's always wise to be mindful of potential risks.
Right.
The housing market is cyclical, and prices don't rise indefinitely. An economic slowdown or a surge in interest rates could apply downward pressure on prices.
It's crucial to keep the bigger picture in mind.
Absolutely. And for investors in companies like AGNC,
Right.
understanding how these broader economic trends could impact their investments is essential.
Let's bring it back to AGNC.
Okay.
What are the key takeaways from our deep dive into their latest earnings and the surrounding market context?
It's evident that AGNC is navigating a complex and potentially lucrative landscape.
Right.
The Fed's rate cut presents tailwinds for the MBS market, but risks like the upcoming election and trade tensions persist.
Right.
AGNC's success relies on their ability to adapt and make sound strategic decisions.
They seem to be playing the long game, focusing on risk-adjusted returns and carefully managing their exposures.
Yes.
It'll be interesting to track their performance in the coming quarters.
Agreed. Their ability to sustain their dividend and consistently generate returns will be key indicators to watch.
And what about the prepayment risk? That seems to be a significant factor that could influence their profitability.
Absolutely. While they are taking steps to mitigate this risk, it remains a factor investors should consider.
Right.
Accelerated prepayments could occur if interest rates continue to decline.
Overall, AGNC appears well positioned to benefit from the current market environment, but challenges remain on the horizon.
Yes.
Their performance hinges on their ability to navigate those uncertainties strategically.
Well said. In this dynamic market, AGNC's management will need to remain agile and adaptable to succeed.
What are the broader implications for investors interested in AGNC and other companies in the MBS space?
It's crucial for investors to grasp the inherent risks and rewards of investing in MBS.
Okay.
It's not a uniform asset class.
Right.
There are various strategies and approaches investors can take, conduct thorough research, understand market dynamics, and choose investments that align with your risk tolerance and goals.
Solid advice. We've discussed AGNC's hedging strategy extensively. How should individual investors approach hedging in their portfolios?
Hedging is a valuable tool for managing risk, but it's not always necessary or appropriate.
Right.
It depends on your investment goals, time horizon, and tolerance for volatility. If concerned about potential portfolio losses, hedging can mitigate that risk.
Okay.
However, remember that hedging comes at a cost and can potentially limit gains.
So it's about striking a balance between reducing risk and accepting potential limitations on returns.
Exactly. There's no universal answer when it comes to hedging.
Right.
It's a personal decision based on each investor's individual circumstances.
We haven't explicitly addressed the upcoming election, which is clearly on everyone's mind.
Right.
And contributing to market uncertainty.
Yeah.
How do you anticipate the election impacting the MBS market and AGNC's business?
It's a question I'm sure AGNC's management is pondering as well.
Yeah.
The election's outcome could significantly impact the economy, fiscal policy, and interest rates.
Right.
All of which have implications for the MBS market.
So it's a wild card.
In a way, yes.
Yeah.
It's challenging to predict the election's outcome and its ultimate impact with certainty.
Right.
However, investors should be aware of it as a potential influencing factor.
It sounds like there's a lot to consider moving forward.
Definitely.
But before we wrap up, any final thoughts for our listeners?
Sure.
Especially those who might be interested in AGNC or the MBS market in general.
I think the key takeaway here is that knowledge is power. The MBS market can be complex,
Right.
but it also presents opportunities for those who take the time to understand it.
For sure.
Stay informed, assess your own risk tolerance, and make decisions that align with your investment goals.
Couldn't agree more.
Yeah.
Understanding the dynamics, the players, the risks, and the potential rewards is crucial for making informed investment choices.
Absolutely. And remember, diversification is key.
Right.
Don't put all your eggs in one basket.
It's true.
Explore different asset classes and strategies to build a portfolio that suits your individual needs.
Fantastic advice. Well, that's all the time we have for today's deep dive into AGNC Investment Corporation.
Okay.
Thanks to our expert for breaking down these complex topics and for those insightful takeaways.
It was my pleasure. Always enjoyed these conversations.
And for our listeners, if you're craving more market analysis and want to keep the conversation going, be sure to find us on TalkTicker's social media channels.
Yes.
We're always up for a good discussion. And who knows, maybe your question will spark our next deep dive. Until then, happy investing.